Guess let's go ahead and begin. So Nice, together with its subsidiaries, provides AI-powered cloud platforms for customers for customer engagement and financial crime and compliance worldwide. It offers, I'm not going to try to say that, an AI platform that enables enterprises to design, build, and operate customer service automation. So we got software application, AI company. It has been dropping for the last 5 years. So always dangerous when you find a company that's been dropping and dropping and dropping. So no matter how it looks in terms of analyst predictions and free cash flow, discounted free cash flow, you got to know, why has this company just consistently dropped for 5 years? And it becomes a lot more clear when you look at it, when you zoom out. So during the AI and COVID bounce back, the AI hype and COVID bounce back, this company just absolutely shot through the roof. It went way up in value really fast, and then it has been falling from that spike ever since. Berkshire took a position in UNH, resulting in the 10 to 12% jump. That's right, I did hear about that. So I was about to say Warren Buffett had my back, but I guess he's not. Actually, I don't know what capacity Warren Buffett has at Berkshire anymore. I know he stepped down, or I thought I heard that he stepped down as CEO. I thought he retired, but I remember seeing posts about how Warren Buffett saved everybody's UNH position. So anyway, not exactly sure what's going on there. But as for Nice, one thing that really jumps out at me as to why this company has dropped in value so much is when you go back in time and look at the ratios from 2020 to 2024. So the PE ratio, when we scroll back here, in 2020, from 2019 to 2020, it went from 51 to 89, and then 89 to 97. And then the PE ratio has been compressing ever since. So we've got major PE multiple compression. This is why the company is dropping in value. So a lot of times when you see price to earning, the PE ratio dropping, the number one thing you think of is, oh, their earnings is probably dropping off. But when you look at their revenue has been consistent. Like during that whole time, from 2019 to now, their revenue has been going up double-digit pretty much percentage every single year. When I scroll down to their operating income, I see 240, and it has gone up every single year. Their operating income goes up. Their pre-tax income has gone up every single year in the last 5 years. And then finally at the very bottom, their net income to common has been in the green every single year. So what's the deal? Why has this company experienced so much multiple compression while they're simultaneously increasing their revenue and increasing their income every year? And this is a great setup as somebody who likes to think. I like to think I'm a value investor. It's not maybe I'm not a value investor in the most traditional sense of the word, because I'm not just looking for companies that are super cheap. I'm really looking for companies that are great companies that look really strong, have a bright future, and I'm trying to catch them at the right time. So this setup initially, when I first saw this, I was like, wow, this is looking really strong. So why have they had such PE multiple compression? It's because expectations were through the moon with this company. Investors thought that this company was going to absolutely explode in terms of revenue, in terms of profits, but then they've had several years in a row that have just been below investor expectations. And most recently, an article that I found on this company for Q4. Let's pull this article up really quick. Nice beats Q4 estimates, but shares plunge on a weak 2025 outlook. So people are expecting, analysts, investors, they're expecting lofty goals for this company. They're expecting really strong guidance. They didn't get it. This has been the story continually, and that is a large reason why this company continues to drop off. They also had their CEO step down recently. Let's see, when did that happen again? CEO Barack Ilam announced in May of 2024 that he would step down. So They've had management turnover. That's not a good thing. It's not necessarily a bad thing. They've haven't really put out the strongest guidance, and so as a result, this company has been just dropping in share price. So this is the kind of story that looks really good to me, because a lot of times when investors have these crazy expectations and they're not met, there's a knee-jerk reaction back down the other way, as like investors are just dropping like flies. They're losing money on this company that they thought was going to be so strong. And then people are just running when they realize like, oh, this company is not going to be increasing its revenue by 20% plus every single year for the next 5 years. They start to drop off. But in this case, this company appears to have dropped way too far. And the reason I'm coming to that conclusion is, as always, I like to use my discounted future free cash flow spreadsheet. So I like to look at the free cash flow of a company, because the free cash flow is the chunk of money that a company uses to return to shareholders. They use their free cash flow to pay off their debt, to expand organically or inorganically. They could have mergers and acquisitions. They can buy back shares. They can pay dividends. There's lots of things, but this is the chunk of money that is most applicable to shareholder return. So that's what I like to look at. I like to discount their future projected cash flows. And the way I do that is I lean on the analyst projections. Okage, future guidance is what's driving a lot of stocks down lately. Crocs, Iridium, ASML. Yes, indeed, you're right, especially with Crocs. And with Crocs, I feel that the stock was already undervalued, and then the guidance was, I believe it was cut for 2025, and so it's dropped even lower. So I've actually scooped up a little bit more on my public portfolio, and also my personal portfolio. I've also scooped up a little bit more Crocs. I have not done that yet with Iridium and ASML, and I may need to look into them a little bit further, but I have not done that yet. So this company, I'm making the case that it has had a knee-jerk reaction too far in the other direction. So first and foremost, let's look at the analyst projections, the forecast tab. Scroll down a bit. Let's see. So analysts are projecting 3 years out anywhere from 4.5% to 12%, pretty much for the next 3 years. This year they've got, it's a little bit lower, but 4.4, 0.3, 3.5. We'll call it between 3 and 15%, it looks like on average. So a pretty big spread, but it's all green. So all analysts are projecting increased revenue over the next 3 years at least. So what did I put in here for my projection? So I copied the 3 years, and then I kind of just extrapolated out for the years 4 and 5. So I went with 10%, 7%, 3%. With those expectations, and we're going to use the same free cash flow margin that has been for the past 5 years. We're assuming 3% revenue growth in years 6 through 10 and a perpetual growth rate of 3%, a discount rate of 8.45. I pulled that number off of alphaspread.com. Except lately, I've actually changed my mind a little bit how I'm handling the discount rate. So I had been using AlphaSpread's discount rate. And they add the risk-free rate to the equity risk premium, but this number is multiplied by beta, which is indicating the stock's volatility relative to the market. And I've decided that I don't want to reduce the equity risk premium by this beta multiple, because in my mind, volatility, it does not equal risk. Like, just because a stock is more volatile compared to the market, to me, that doesn't mean that it's more risky. So I think from now on, I'm going to ignore this beta, and I'm going to just add the risk-free rate and the equity risk premium together. The more I think about it, I don't really see the case for this beta. And now in this instance, it's not making a very big difference at all. It's 0.98, so it's having hardly any impact. But just so you all know, I'm now just adding these two values together. It gives me a higher discount rate in most cases, so 8.45. With those assumptions in place, the lowest analyst projection has a 55% upside. That's a fair share price of 213. NICE's current share price is 138. So that is a huge upside. The highest analyst is 127% upside. Now, one thing I do want to adjust is this free cash flow ratio, because A classic mistake that a lot of people make when they're doing these discounted future free cash flow calculations is they're not taking into account stock-based compensation correctly, in my opinion. So stock-based compensation, this is actually a significant portion of the net income, this is when you really want to make sure you take it into account. So the way free cash flow is calculated, you take the operating cash flow and you subtract the capital expenditures. And I will also subtract a portion of the cash acquisitions, because cash acquisitions do come with additional capital expenditures in the future. So there's going to be some portion of that is lost. And so I do account for a small percentage of that. But that being said, stock-based compensation gets added to this number. This net income is increased by depreciation. It's a non-cash expense. It's also increased by stock-based compensation, which is a non-cash expense. However, when you scroll down a bit further, this company is turning around and they're repurchasing stock. So they're giving stock away, they're buying it back. This is essentially them spending cash in extra steps. So I reduce their free cash flow by 90% of their stock-based compensation. And in doing that calculation right here, this happens automatically on my spreadsheet. You only have to decide the percentage of each thing you want to punish or reward. So in this case, I'm punishing 10% I'm rewarding 10% for R&D, rewarding 10% of CapEx, punishing 10% of acquisitions, and then punishing 90% of stock-based compensation. That gives me a new average of 18.66. So I am reducing this by a big chunk, reducing it by 6%. That still leaves me with a low analyst upside of 20%. And then another thing I was messing around with, just reducing these even further to see what does the market expect to happen. I always like to do this exercise. I will reduce the projected revenue growth to see what the current share price implies that the market is thinking about future growth. So if I drop these down to 1, 1, and 1, looks like I dropped it a bit far. Let's do 1.5. So that would imply, that's my projection right here. This takes into account all three of these. So 132, the market is saying that this company is only going to be able to grow their revenue by 1.5% starting now forever. So less than inflation. And I just don't buy that. I do not buy that this company is going to only be able to grow their revenue by 1.5%, especially when we think about the trend that is AI. A lot of this company's revenue comes from cloud, software as a service, subscription based. So they do a lot of cloud stuff. And I have their earnings by segment pulled up on one of these tabs. Let me just pull this up here. This is their total revenue. So in Q2 of 2025, their most recent quarterly report, they increased their year-over-year revenue by 9%. They increased their cloud revenue by 12%. Their operating income increased by 9%. So this company is looking really strong in terms of cloud. Software as a service business model, subscription business model is very consistent. It's very sticky too. So yeah, we can see that their annual revenue has just been increasing every single year, looking really strong. But let's find that breakdown here. Here we go, cloud, services, and products. So this is a little bit of a red flag. Their other segments are decreasing, and the market could be seeing this as a problem. 2022, their services was 73% of their total revenue. Oh, wait, no, I'm reading that wrong. Sorry. Healthy growth. Oh, this was their margin. Sorry, there's another graph that shows their total revenue. My apologies. Let's see. Find it. Well, maybe I'm on the wrong visual, but in any case, their other two segments are decreasing, but their cloud segment is increasing very rapidly, and that is where they're getting the majority of their revenue gains. So, Okage, do they have future guidance as in revenue by 2030? I don't believe they offered 2030 guidance. Let me pull up their most recent quarterly report where they gave their full year guidance. So the company exceeds the high end of its total revenue guidance range, double-digit year-over-year earnings per share growth. Let's keep going. Down a bit further. Okay. Full year 2025. The company reaffirmed full year 2025 total revenue, which is expected to be in the range of 2.918 billion to 2.938 billion, representing a 7% year-over-year growth. And when we compare that to the analyst projections, I believe that's right in the middle. Let's see here. So yeah, analyst projections are putting it at 9. 2026, they're putting it at 7. And then 2027, they're putting it at 10. So now this is a new CEO. A lot of times new CEOs will want to be conservative, overly conservative with their first full year guidance, because if they come out swinging and then they miss their guidance, it looks really bad. New CEO misses their first guidance, like, ouch. So a lot of times they will be pretty conservative with their guidance. So that is something to bear in mind. So I think much more reasonable going with 2.5 is just really, in my mind, overly conservative. And with 2.5 revenue growth, that means we're 12% undervalued currently. And that is assuming we get an 8.5% annual return. So in my mind, this stock is just insanely overvalued. One thing I also want to look at are their financial red flags. So let me pull up my Buffett supplement. So for those of you who are new to the channel, oops, did I kick the camera? No, okay. For those of you who are new to the channel, I like to use Warren Buffett's red flag. So he has several metrics that he looks at on a company's balance sheet, income statement, cash flow statement, where he says if they're exceeding a certain baseline, then they have a strong chance of having a competitive advantage over their peers. And if they're under a certain baseline, then that's a red flag. There might be something going on. So when I look at companies, I look for companies that have as minimal red flags as possible. If too many red flags show up, that's just not a good use of my time. There's so many other companies out there that just don't have any red flags. I'd much rather spend my time researching those companies that don't have many red flags. And then if the cells are highlighted green, then it's a green flag. So I'm not seeing any red flags when I quickly, there are 0 red flags with this company. According to Warren Buffett's metrics, I'm only seeing a few green flags. So they have high gross margins. Their selling, general, and administrative expenses are in the neutral zone. Same with research and development. Their interest expense as a percent of operating income is near 0. And I love to see this one. This just means that they have almost no debt. Having a lot of debt is one of the biggest risks, in my opinion, when I'm finding a company that appears to be undervalued, because if they have a high debt payment, not only does that interest eat into their profits, eat into their earnings, it eats into their liquidity. It makes it more difficult for them to grow. And then if they have a very high interest payment, then they're going to have some big debt maturities coming up in the near future, most likely. So I always have to dig a little bit deeper to see what kind of big debt payments are going to be coming due in the near future. And then sometimes that creates problems where if they don't have the cash on hand to pay and service their debt, a lot of times they'll have to issue more shares, which dilutes shareholders. So dilution is one of the big things that can result when a company has really high debt. And so this being a green flag takes a lot of the risk off the table. Really strong profit margin. If it's over 20%, then Warren Buffett calls it a green flag. They're at 16.18, so pretty strong. Their earnings per share and profit have been going up every year. Long-term debt divided by profit. So they get as much profit every year as they have long-term debt. So it's no problem for them to pay off their remaining debt. Retained earnings goes up every year. Their cash level has gone up in the last year while their debt is going down, so that looks good. Their goodwill has not taken any big hits. Their capital expenditures is low compared to their earnings. Their depreciation is relatively low. It's in the neutral zone. If it's under 10%, it becomes a green flag. So they're sitting right at the borderline at 11%. And then their adjusted current ratio is green, meaning they have plenty of liquidity. Their share count has not been going up, so that's another thing I like to look at. Let's go back to their financials and see how much money they're actually putting into buying back shares. Let's see. So that's on the cash flow statement. Let's scroll down here. So looks like they've been increasingly adding more and more into their repurchase of common stock, which, as this company has been dropping in value every year for the last 5 years, I love to see that. I love to see a company buying back its own shares. It shows confidence that they're undervalued, and it's more bang for your buck as an investor because they're able to pull more shares, increasing my size of the pie when their share price is extra low, which it is in my opinion. They've been using that cash to pay off debt, buy back shares. They currently do not pay any dividends, but that's not a problem with me as long as they are continuing to buy back shares. They are investing in securities, a pretty hefty chunk the last year, and they have been using cash acquisitions, $400 million in 2023, I guess that is, $64 million in 2024, and then over the trailing 12 months, $100 million. So they're reinvesting a lot of cash into the company, buying back shares. It's only a matter of time until this company continues to see their PE ratio start to recover as they reduce their share count and increase their earnings. Hokage says, have you tried uploading the financial PDF to AI to make it easier to get the details? I'm not sure if it works. Are you saying like to upload their latest earnings report, like their like their latest quarterly report, to have AI summarize it? Or I'm not sure exactly what you're asking. What I do is I use ChatGPT-5's deep search function, which I would like to share with you. This has been, I don't know if I would say a secret weapon or maybe like a dirty secret, but it has been just, it accelerates my research time so much. So let me just show you what kind of stuff I'm getting off of ChatGPT here. So the prompt is simple. Help me understand why NICE share price is lower today than it was 5 years ago, while the company has consistently increased revenue. Okay, Hokage says yes, summarize and find future guidance. Yeah, and I have used AI to find future guidance. In this case, ChatGPT may have commented on it, and that's why I knew that they only did I don't remember how I knew that they only did the full year of 2025, but absolutely. But I don't have to upload PDFs or anything because ChatGPT-5 is able to browse the internet. And so it asked a few clarifying questions, nothing crazy there. And it's not showing. Oh yeah, here we go. So it did a 14-minute search. It looked at 31 sources. It did 94 searches. Yeah, it speeds up research time so much. And at every point it gives me sources to look at to verify, because you can't always just 100% trust ChatGPT and the conclusions that it comes to. It will make some leaps of logic from time to time. So if ever you see something that's like, oh wow, like that's an interesting summary, definitely click on the source and verify that it is the case. So ChatGPT broke it down into macroeconomic factors, market-wide factors. Basically, rising interest rates is a problem. I should have gone over this, actually, I forgot. So rising interest rates is a problem for companies that are trying to grow because the cost to borrow money is going up. It just makes it more and more difficult. This is not a factor for NICE because they are able to fund their growth with their cash flow. They have very little debt, so I don't really see that as a problem. Yeah, that is nice. So yeah, I'm not seeing rising interest rates as too much of a problem. Multiple compression, I did go over, and the macroeconomic factors are also a reason why we saw such multiple compression with this company. Tech sector rotation and sentiment shift. ChatGPT is saying the market sentiment shifted a bit. Economic and geopolitical factors, tariffs, there's a lot of uncertainty right now. Let's see, company-specific factors, the management changes we talked about, strategic decisions and acquisitions. So this is one that I don't really see. The ChatGPT is listing this as a red flag, basically saying that they've started participating in acquiring other companies, and so that implies that their organic growth is going to be weaker. I don't have any problem with acquisitions like as as a concept. I think if it's the right company and it's the right fit, there's nothing wrong with that. So that's going to be on a case by case basis. And I didn't see anything compelling that would lead me to believe that any of the acquisitions were necessarily bad. So product transitions. So they did change their business model from software products. Now they're really focusing on subscription based. So in that transition period, they did see a little bit of margin shrinking, but the margin has been recovering. So let's pull that up actually. Definitely in the free cash flow margin. Yeah, we can see here free cash flow margin. It had dropped down to 20 and 22 in 2022 and 2023. The previous high, it was up at 27, 25, 26. And now we're back up around 29, 26. So margin is increasing again. Yeah, I just think that this company is looking so strong. It has dropped so much more than it should have. And yeah, we can see that right here with this discounted future cash flow projection. Just assuming 2.5% revenue growth going forward, and the shares are still 12%. We have a 12% upside. The fair share price, assuming we're targeting an 8.5% return every year, then 155 would be a fair share price. And that's something to really consider when you're doing these kind of analysis. What you're making the case for is, what do I think this company will exceed? So if I want at least an 8.5% return, then I need to be buying it at 155. And that's if they hit this on the nose. They're probably going to exceed 2.5% revenue growth every year. So if they exceed that, then my upside is going to be much more than 8.5% per year. As long as we do not see the market continue to compress the multiples on this company. If new information comes out and future earnings for AI, for the cloud services that NICE offers, if things change with the company, that's one thing. But all things being equal, assuming the analysts are correct that we're going to see an average annual return of around 7% going forward, then our upside is going to be much higher than 8.5%. Yeah. So assuming, that's an 11% upside. So Tommy Shelby stumbled upon this live. This is nice. Very good. I like what you did there. Thank you very much for the comment. I do appreciate it. So this is that about wraps up my analysis for this company. I will be investing $100 into NICE this week. I invest $100 every week. I typically will target a different stock every week, but some weeks I will review my portfolio and see, are there any companies that have dropped a little bit more since I bought them? And I will evaluate those companies and see, are they an even better deal than before? Do I want to spend more money? Do I want to invest a little bit more into this company? And then companies, or do I want to drop it altogether? And then companies that have increased in value significantly, I will also look into those and see, is it time to sell? Has this company increased its share value way too much? I need to drop it, or is it looking strong still? Okay, Hokage, help me understand this a little better. Assuming we hold this stock for 10 years and I buy at 155, then the expectation is the growth would be 8.5% for the next 10 years. 8.5% per year for the next 10 years. This discount rate is our annual return if we keep getting our free cash flow based on this revenue increase and this margin. Well, and I need to change how I do this actually. This is 24. This is the average free cash flow margin over the last 5 years. So that's 24.5, and then I'm subtracting 6 from it. So I need to change how I represent this. I should make it to where you just type in the cell what you want the free cash flow margin to be. I feel like that's a little bit confusing. So anyway, 18.5% free cash flow margin, increasing at 2.5% revenue per year would give us an 8.45% return per year every year. Tommy Shelby, thank you. I appreciate it. You like the analysis? Yeah, man. Go back and watch the full video. And I stream every week on Wednesday around 7:15. So that is the plan. If I'm not going to make Wednesday, I will be sure to do a community post on the channel so you guys know that maybe I have something up, something's going on where I can't make the stream. But that's the plan every Wednesday. No problem, Hokage. I'm glad that made sense. Tommy Shelby, as someone working in tech, trust / dev role, sorry, I'm not understanding that, is really important. If that doesn't pick up for nice, then it is tough. Okay, so you're saying in the industry, and that's something that admittedly I don't have. I don't have the industry specific knowledge for this company. Nice, subscribe with notifications on. Thank you, Tommy, I appreciate it, man. So yeah, if you have industry specific knowledge, that is highly valuable. I am not aware. Oh, DevRel is developer relations. Gotcha. Yeah, I don't have the industry specific knowledge, so that is something that's where I really lean on the analyst projections, because my assumption is that the professional analysts are plugged in and they're making their revenue assessment based on that knowledge. So if you have some information on, if the trust isn't there, if the developer relations are not there, that is interesting. And that would, if that is the case, then I would understand if that gave you pause to invest in this company. So yeah, I would say, I'm leaning quite a bit on the analyst expectations for this company. Okay, so let's change up these figures a little bit. So let's go with something a little bit more realistic. So for the next 5 years, I'd like to assume that the analysts are correct. We'll say 7%. For the years 6 through 10, I'm going to be a little bit more conservative and bring it down to 5. And then we'll use a perpetual growth rate of 2.5. And with those assumptions in place, then my projection using all three of these would give me a 43% upside. To me, that seems pretty conservative. Like, these revenue numbers seem conservative to me. The free cash flow margin that I'm rolling with seems pretty conservative, especially when you look at the recent free cash flow margin. So in 2024, taking into account the stock-based compensation, the free cash flow margin is 24%. So the only reason I'm rolling with 18 is because I'm using the average over the last 5 years. But if they are trending up, like if their margins are going to be recovering quite a bit as they, are finding their momentum with their new subscription-based revenue source, and this becomes the norm, that's something I haven't taken into account yet. That would lead to an even greater upside. So let's say that they continue to increase their percentage over the next 5 years, showing this gold is my free cash flow margin assumption. Let's say it does trend up over the next 5 years. That now gives me a 75% upside. So, this seems conservative to me. However, even with the overly conservative take that is they're just going to increase their revenue by 1.5%, then the investment still makes sense. And so I'm looking for what is the scenario that this company is likely to exceed. I'm not going to invest in a company looking at the pie in the sky scenario. Like, oh my God, this could happen. And if this does happen, then I'll have good returns. I want to look at a scenario they're so likely to exceed this scenario. But if they don't exceed it, if they just barely scrape by, then I'm still going to get a return. That's what I am looking for. I'm looking to get the most reliable long-term returns on this company, on all investments. That's what I'm looking at. I want to see the biggest possible upside based on a super conservative outlook. And so this to me seems believable. 7, 5, 2.5, giving me a 75% upside on top of my 8.45% return. It seems good to me. So, okay, I think I am ready now. I said this before. I think I'm ready to wrap up this segment of the stream. If anybody has a company that they want me to look at, we can do a quick, not a super deep dive, but a quick look. Let me know in the comments. I'm happy to check out a company that you guys want me to look at if you see something interesting. Hokage just ran some numbers. If all goes well, 10 years conservatively, it could hit 350, on the high side 445. Yeah, I believe it. It very well could. I would say it seems likely to me, based on pretty conservative revenue projections. So yeah, I think this company has dropped quite a bit in value, and investors have that kind of recency bias where they remember that this company has just been dropping. And a lot of investors, they're not doing this type of analysis. They're looking at just relative prices. They're looking at what is the price action, and they're seeing a company that's been dropping for 5 years, and they're like, yeah, like why yuck. Why would I want to continue to invest in a company that's been dropping for 5 years? But when you look at the profitability, it tells a different story. Tommy will definitely be ready with some questions next week. Nice. Hokage, good night. Looking for the next live, maybe revisit some companies from past videos where you considered it to be overvalued, but now they have dropped. That is an interesting idea. I do like that idea. I like that a lot. I'll have to look and see. Yeah, momentum sucks, but we love it. Yeah, it can be a double-edged sword, because I understand that on average, momentum is a hell of an indicator. Yeah, momentum investors who are, I want to say there are ETFs that trade based on momentum, but it's, we're talking hundreds of companies. So it's highly diversified, and they're trading off of momentum. And my understanding is that those ETFs do pretty well. So on the aggregate, on the averages, momentum, people find success with it. But on a case-by-case basis, as a long-term investor, I would say, yeah, for my purposes, momentum sucks. I can't use momentum. I've got to just look at what is the company doing? What is the money that they're bringing in? What is the money that they're projected to bring in the future? So, yeah, let's pull up Crocs. I talked a little bit about Crocs earlier. Crocs has taken such an unfortunate turn, but I just want to show really quick, if we use some incredibly conservative numbers here, 1.5%, the same numbers that we used on NICE, and the upside for Crocs is massive. 107% upside if they just do 1.5% revenue growth and they hold on to their margin. And that is an important part of this. If their profitability drops, then this assumption does change. Now, when I go down here, I do need to adjust the average down to 17. But I would also point out that I should probably ignore this year. They had massive expense on cash acquisitions, which drops their free cash flow margin by quite a bit. Oh yeah, what happened with Crocs? I heard some results were bad last quarter. So the results from the quarter were actually really strong. I think they had the most gross profit that they've ever had in the history of the company. However, they actually just took away their future guidance for 2025. Basically, they're saying, we've got new tariffs rolling in. We can't predict what tariffs are going to stick and which ones aren't. So we are retracting our guidance for 2025. To my memory, that's what happened. And so when a company says, hey, I know we gave this guidance before and you guys were investing based on that guidance, but we're saying don't use that anymore. The implication is that they're going to do worse than what they said they were going to do. That's the implication. That's not necessarily what's going to happen, because if the Trump tariffs, if Trump's able to work some deals with different countries, then maybe the tariffs won't be as bad. But in any case, Crocs is saying, we're not gonna we're not going to try to guess. So that's what happened. Yeah, big whoops. So 7%. This 2022 is an outlier. It's bringing down the average. I could probably use 20% as my average here instead of 17. So I'm just going to stick. It's at 19. I'll keep it at 19. So if I'm assuming, let's say that, oh yeah, they're primarily made in Mexico, Indonesia, and China. Yes, correct. So anything that they're bringing in to America is going to get hit. And then they also sell a lot of stuff internationally. So Crocs, of their different segments, their American segment is actually in decline, but their international segment is doing phenomenally. We're talking double-digit revenue growth internationally. It's dropping slightly in America. And I think, most of the investors, I'm pulling this out of my butt, but I feel that most of the investors are probably American. And the American sentiment on Crocs is like not very good. Almost everyone I talk to, they say that Crocs are ugly. Now, personally, I like Crocs. I think they're functional. I would never wear them out. I think they got a bad rap because people were, when that first Crocs fad hit, a lot of people wore them out. They're not like very good looking. So you wear them out, people are going to make fun of you, But as a functional shoe, as a water shoe, a boat shoe, you got to do some work in the backyard. You slip on the Crocs. You want your toes protected. I mean, I personally like Crocs, but I'm not going to wear them out. I agree. I'm from Asia. Okay, they're super popular, but yeah, here in the U.S., it's not that much. Yeah, 100%. So I think a lot of that investor sentiment is coming from the American investors. That's a little bit of, throwing that out there based on vibes. I haven't researched that, but that's my impression. So, yeah, so what is the market saying? Let's look at what is the market saying is going to happen. If the market thinks 0% revenue growth, like they're just going to flatline, they're never going to grow their revenue, even though inflation is going to decrease the power of the dollar, they're not going to make any more revenue. That's what this is saying. So, in other words, their revenue's kind of dropping in a real sense by inflation every year. But yeah, at 0% revenue, still 61% upside. So let's just keep going. Let's put negative. If Croc loses 1% every year forever, still a 40% upside. And and then I should probably answer this question. How can a company continually make less and less and less and less money while still bringing return to shareholders, right? It kind of sounds counterintuitive. How can their profits actually drop every single year, right? The way it happens is the profits that they do make, if they are buying back their shares, even though the profits are going down, the profit per share can actually go up if they're able to buy back shares faster than their profit is going down. So it sounds a little bit counterintuitive, but that is what can happen. They can actually lose money every year forever and still bring in 8.5% return to shareholders. So let's go even further. Let's go -2 every year forever. Still a 21% upside. It's just crazy. I mean, the market thinks that this company is going to be dropping. Okay, finally, we hit close to 0. So the market is saying that Crocs is going to start losing 3% revenue forever. So the market is saying that Crocs is done. That's what the market's saying. As soon as the market realizes that Crocs is not done, then I think we're going to see a major correction in Crocs share price. I would give one recommendation. This is Hokage. As you know, with a short attention span for a lot of people today, maybe add some shorts on your picks for the algorithm gods. Hokage, you're not wrong. As far as YouTube algorithm is concerned, I think you're probably right. Do I have the right mic? I may not have the right microphone attached. I know you said earlier that it sounds good. Does my audio sound better or worse or the same in your experience with my channel, Hokage. But yeah, I mean, you're 100% right. The algorithm gods would like to see some shorts. I just can't bring myself to do it, man. Yeah, Tommy, I know. I understand it would be good for my channel to short some stocks, but I can't bring myself to do it. I don't believe in shorting like very often at all, and here's why. So, okay, it sounds okay. Thanks. Here's why. So, even though a company is overpriced, there's two reasons why I could still backfire if I short it. So, I could be 100% right. They are overpriced, but my short expires, or if I'm doing a put, my put expires, before the stock price actually drops. Everyone understands that. Puts have an expiration date, so you can get screwed there. If I'm actually shorting shares, then I have to pay interest, and so I'm losing money that way. So time is a big issue, and it's just there's no way to know when it's going to happen. Like I've been okay, oh wait, you mean YouTube shorts. Oh, YouTube shorts. Is that what he means? Oh, add some shorts, like YouTube shorts. Oh, I completely misunderstood. Um, maybe I should. Maybe I should. I've not shorting stock, right? Maybe I should. I've tried doing shorts in the past, and I didn't do a very good job of shorts because we tried to just clip parts of videos that seemed like you could clip, but they didn't really work very well. So okay, oh gosh, yes, YouTube shorts. Okay, my bad. If I actually made dedicated shorts, I think it would probably work well. You're probably right about that, Hokage and Tommy. The thing is, do I have the time to do that? And maybe I should make the time. Maybe I should. But don't do it immediately after a live. Add it a week. Okay. Maybe I'll give that a try. So do y'all watch a lot of investing shorts content? Is that I haven't really dived into that section of YouTube yet. I watch long form investing content, but I haven't really looked into the shorts very much. I just assumed that there wouldn't be enough value that I could maybe, I guess I wasn't sure if there's enough value that could be crammed into a short, because a lot of times when I'm looking at a company, I guess for principles, like learning about investing principles could be good, but I guess I'm curious if y'all are seeing shorts on individual companies that are performing well. I'll have to look into that. Not a bad idea. But since I was, on my soapbox, I'll just finish what I was saying about shorting a stock. So yeah, the time span can be an issue, but also whenever I do this analysis and I find that a stock is overvalued, it doesn't mean that the stock price is going to go down necessarily. The stock price could just be flat for years. It could be roughly flat. It may never drop down enough to be to make for a profitable put. You know what I mean? It might be relatively flat. It might only increase by 1% for 10 years or something, So there's other ways that a stock can finally reach its fair value besides like dropping down to the fair value. It can just have bad returns for a long time, and in which case you don't make any money off shorting it, because it still went up that whole time. So everybody loses in that case. The people who went long, they lose. The people who went short, they lose. It's only the people who are selling calls and selling puts. Okay, Hokage says usually they're not authentic, just clickbaits or some day traders running behind another pump and dump. Yeah, and you know what? That was my shorts in the past probably fell into that category, because we were just taking snippets of videos and putting it in. And so I feel the viewers could probably tell that I wasn't putting in work to actually craft like a good short. I was just like trying to cut out little short segments, So not a bad idea though. Not a bad idea. So yeah, What do y'all think about? I mean, what do y'all think about this on Crocs? 3% drop of revenue forever. That's what the market thinks. The market thinks that Crocs is done. I'm just not seeing that, and so that's why I'm a believer. I'm a believer in Crocs. Another company, UNH, with 0% revenue growth. It seems that they are about at their fair share price at 0% revenue growth. And actually, that's using a 6.81% pass free cash flow margin. What is their actual margin? 6.31. Okay, so that is in line with what their margin is. So yeah, I think UNH still looks pretty good. I can't remember what their projections were for their revenue. Let's see. Analyst revenue projections. There is a big spread on their revenue projections. That is true. At least in 2025, there's pretty good consensus. But going forward, there's a big spread. Let's see how that changes things. Okay. Yeah, so, and that's with, so I'm using the analyst projections, and then I'm also assuming 0% revenue growth after the analyst projections expire. So years 1 through 5, we got the analyst projections. Years 6 through 10, we've got 0, and then perpetual, we've got 0. And that's more or less what the stock market is saying. That's what they think is going to happen. But let's throw 3 in there for years 6 through 10, and we put a 2% for perpetual growth rate, a little bit less than inflation even, and suddenly we're seeing a 20% upside. And that really goes to show how like this perpetual growth rate assumption is a large assumption. Like this number makes for a pretty large chunk of the future free cash flows. Even though it's further out, it's getting discounted a lot. Forever is a long time, and so it's important to make sure that we're not overreaching with this perpetual growth rate. And when I put 2 in there, less than inflation, we're still seeing a 20% upside. I think UNH is still looking pretty good. Tommy, all right, got to go grab dinner. Nice meeting y'all. Notifications are on. See y'all next time. Thanks for tuning in, Tommy Shelby. I appreciate it, man. I'll see you next time. If you're still around, I hope I didn't miss you. Okay. So yeah, that's UNH. Oh, and I need to bring up, I almost forgot, I got to do my portfolio review. All right, let's pull up the portfolio here. Okay, what do we got? Oh, it's on a compressed screen, so I don't know what I'm clicking here. Okay, invest, YouTube. We've got the YouTube portfolio pulled up. Filter by gains and losses. HIMS still on top. BTI continues to do better and better. It's now 60% to the upside. It's got a huge dividend. I need to do another review of BTI, I think. I know I did one recently, but now it's up even more. Yeah, this was one that, gosh, I wish I would have had a little bit more conviction when I originally invested and, put a little bit more. But, hindsight is 2020. Oh yeah, this one has just turned out so well. And the current dividend is 5.17%. So that is really nice to see. Where were we? 60% capital gains with a 5% dividend. Capital One Finance has been doing really solid. That's one where I love Capital One. I'm a customer. I use Capital One credit cards. I think the Venture X is the best credit card out there for, like, I would say most spenders, assuming you're going to take at least like one trip per year where you're going to fly somewhere. As long as you're flying once, then the Capital One Venture X credit card is hard to beat it, because you get a $300 credit for travel if you spend it on the Capital One portal, and the portal is great. And then you also get $100 in points. So it completely, like, the annual fee is $395, and so with the $100 in points and the $300 travel credit every year, it more than pays. So you're guaranteed to get your annual fee reimbursed every single year. And then now what you're left with is a premium credit card which has lots of really good perks that normally you're paying, $395 a year to have, but now you get it for free basically. So yeah, I'm a huge fan of that credit card. HCA, ASML, UNH, these are all up there, UHS. But when we scroll down to the bottom, this is where we hide our picks that are not going well. Crocs down here, second to last, but mark my words, I believe in Crocs. But some of these we should probably look at again. Nice, just bought in, so I'm currently down 0.5%. I think I bought in the day before, so we're at 99.32, but I feel really strong about Nice. I think Simply Good Foods would be one that I should look into again. And actually, we could do a quick check on Simply Good Foods. Simply Good Foods was one that I invested in, assuming SMPL, is that right? Assuming a bit more growth than some of the other companies that I invest in. I'm usually more conservative than my thesis for Simply Good Foods. So let's pull it back up again, SMPL. So what's happening here? Looks like my spreadsheet is broken. Yeah, I typed it in right. Forecast. Man, the analysts' stock price projections all look really good. If we scroll down, the analysts are all saying it's either strong buy. We got 3 strong buys, 2 buys, 3 holds. Nobody says sell as far as the analysts are concerned. And then their projected revenue growth is looking really good. It's all in the green. So I think with this company, I assumed their profitability would increase. And something is going on here. What happened here? Their revenue is not coming through for some reason. So unfortunately, I won't be able to look into this company live because something is wrong with the equations that I use to pull revenue. The spreadsheet's automatic. I type in the ticker, and it's supposed to pull revenue projections off of stockanalysis.com. Sometimes Stock Analysis will change the format of their tables. They'll change the titles on the rows or the columns, and that will mess up my spreadsheet. So something like that has probably happened. So I need to look into that. Okage says, Capital One Venture X is amazing. I have it too. HG is doing very good lately. Is that Hilton? HG. Hamilton Insurance Group. Hamilton, that's right. Yeah, I forgot about Hamilton. It has been doing well. That'd be another one I should look at again. SMPL is getting beaten. I don't see why. Somewhere there is divide by 0. Yeah, you might be right. I really don't want to get into it too much right now, but what we can do, well, hold on. Let me see if I can look at the Buffett, because this was a company that I invested in before I built this Buffett supplement. So let's take a look at the Buffett supplement. Not seeing any red flags. Profit margin in 2020, 2021, and 2022 was in the red, but they have been increasing their profitability. It is borderline, so that is something to take note of. If it's below 10, it becomes a red flag. So we've got borderline profit. Long-term debt is low. So on a riskier stock pickup, long-term debt being low is very nice. Their inventory and their profits have been going up in tandem. That's always a good sign. Their retained earnings has continually gone up. Their debt has been going down for the most part, although they did pick up another $100 million in 2024. Their cash reserves have been going up. Goodwill is up. Lots of green flags here. Capital expenditures, depreciation is 0. Adjusted current ratio is a green flag for some reason. Oh, over 1. Yeah, that's what we want. So yeah, I mean, in terms of their financial health, they look pretty good. What is going on with this company? Is it the forecasts look good? The financials. So I remember one of the assumptions I made was that their free cash flow margin would improve with time. And as we can see, 12.5, 9, 12.8, 15, and then 12. So they've kind of been bouncing around. I will need to revisit and see with some more conservative free cash flow margin assumptions, how are they going to do? That is what I need to look into. They have not been buying back any shares. They've actually been diluting, but just ever so slightly. It's really not enough to really worry about, in my opinion. In terms of their debt, let's see. You forgot to place your buy order for today's pick. On that note, I'll drop off too. Good night, Hokage. Appreciate you, man. Catch you next time. I did already buy Nice, so I know I've been doing that on stream from time to time, but with this one, I went ahead and just bought it off stream. Sorry about that, but I already picked up Nice. But yeah, man, we'll catch you next time. Thanks for tuning in, and I will probably drop off here pretty soon as well. I'm gonna look a little bit more at Simply Good Foods, and then we'll call it a night. Okay, so yeah, repurchase common stock. They're buying back a little bit, but they're also issuing shares. And then they also have stock-based compensation. So between the stock-based compensation, they are diluting, but just ever so slightly. I don't know that it's a big issue. They have been performing cash acquisitions, and they have been issuing a little bit of debt. But their net debt issued, it did go up in 2024. It had been going down the past 3 years. So the fact that they had to pick up a little bit of debt, maybe a little bit of a red flag. But yeah, they seem okay. They seem okay. I'll have to do a deep dive into this one again someday. But in any case, that's all I got, y'all. For those who are still tuned in, thanks for watching. We'll catch you next time. Next Wednesday, 7:15. That's my schedule. So we didn't have any viewer recommendations for stocks to look at, but if you guys want to see a stock in particular, if you want me to look into one live on stream, do a little bit of analysis, I'm happy to do that. So I'm always interested to see the companies that you guys are interested in. And it also makes my job easier, because if you guys do the work and find some really great companies, then I get to benefit from that. So anyway, that's all I got. Catch you guys next time.